A regime shift is forming in global markets, and it's the kind that breaks portfolios quietly, then all at once. Because the story everyone anchored to for 2025 is starting to fade: rate cuts. The idea that the rich world would keep easing, volatility would stay calm, and risk assets could float higher. But now, even Bloomberg is flagging the new reality. The rate cut momentum in advanced economies is losing steam, or possibly ending. Central bankers are stepping back, watching inflation, watching growth, and the Fed's outlook for further cuts is suddenly cloudy. And when the rich world stops cutting, something important happens. The global carry trade doesn't disappear. It mutates. And that mutation is what sets up 2026. Because the carry trade is back, and it's been electrifying emerging markets. One measure of EM carry is up massively this year, the best performance since the post-crisis era. Investors have been collecting yield in high-rate countries while FX volatility collapsed and the dollar weakened. That's the perfect carry cocktail. But here's the part most people miss. The carry trade everyone remembers from the last cycle wasn't Brazil. It wasn't Mexico. It wasn't South Africa. It was one chart: USD JPY. Borrow cheap yen. Buy higher yield dollar assets. Collect the spread. Ride the trend. That's why yen carry unwind became shorthand for global risk turning. But in 2025, the carry trade changed currencies. Now a big part of the trade is increasingly built around something else. Short the dollar into high-yield emerging markets. Not buy dollars versus yen, but fund in dollars, sell dollars, and reach for carry somewhere else. And that sounds crazy to people who grew up with the idea that the dollar is always the safe haven. Yes. But that's exactly why it matters. Because when the funding leg changes, the crash mechanics change. If the trade is yen-funded, you get one obvious stress siren: USD JPY ripping higher or lower as the unwind hits. But if the trade becomes more dollar-funded, the unwind can spread faster. It hits a basket. It hits multiple EM currencies at once. And it hits the psychology of short dollar positioning right when everyone realizes they're on the same side. Now, connect that back to the rate cut story fading. This is the new setup for 2026. Advanced economy central banks are no longer racing to cut. They're pausing. They're debating. Some are even starting to talk like hawks again. And one central bank matters more than people think, because it directly changes global funding conditions: the Bank of Japan. Bloomberg's week ahead is explicit. The BOJ is widely expected to hike. And that's not just a Japan story. A BOJ hike is a volatility story. Because Japan has been the world's cheapest source of funding for years. So if the BOJ tightens while the Fed is cloudy and the ECB is talking tougher, the global rate map becomes less friendly for leverage. That's the first hidden threat to carry in 2026. The second hidden threat is even simpler: volatility. Carry is not a return strategy. It's a volatility strategy wearing a yield mask. When volatility is low, carry looks like free money. That's when position sizes grow. That's when leverage is cheapest. That's when risk models give traders permission to press. And then one day, a currency move erases months of carry in hours. Bloomberg's EM carry piece basically admits the problem. Volatility is extremely low. And some managers are worried the benign story is already in the price. Translation: the trade is getting crowded. And crowded carry doesn't break gently. It gaps. So what actually flips this in 2026? There are 3 triggers, and you only need one. The first trigger is hot US. If US growth or inflation surprises on the upside, you don't even need the Fed to hike. You just need the market to stop pricing cuts and start pricing higher for longer. And the moment that happens, short dollar carry becomes the wrong trade. Because the dollar stops being a funding currency and starts acting like a gravity well again. The second trigger is risk off. This is the classic carry killer. A recession scare, a credit event, a sudden equity drawdown. When risk appetite drops, investors don't slowly rebalance out of carry. They run, and they all run at the same time. The third trigger is policy shock: tariffs, election volatility, central bank surprises, geopolitical headlines. And Bloomberg just reminded you that the rich world has stepped back into a world where policy uncertainty can return fast. When FX volatility is priced near the floor, the market is effectively uninsured. So when the headline hits, the repricing is violent because everyone scrambles for protection at once. Now, here's the macro pulse payoff. The most important question for 2026 isn't which EM currency has the highest carry. That's the beginner question. The real question is, which funding regime are we in? Because if the world stays in soft growth, calm inflation, and central banks don't shock, carry can keep working. But if the rich world stops easing, the BOJ tightens, and volatility starts waking up, carry changes from income to incident. So here's what we are watching, and it's simple. 1. Do advanced economies keep pausing, meaning rate differentials persist, or do they reignite the easing cycle? 2. Does the BOJ hike? And if it does yen strength or Japan-linked funding stress show up in global markets? 3. Does FX volatility stay dead, or does it start climbing off the floor? Because the moment volatility stops falling, carry stops being a tailwind. And the moment volatility rises, carry becomes a crowded door everyone tries to exit at once. So yes, the carry trade may still run in 2026, but the risk is no longer carry stops working. The risk is that the funding leg has changed, volatility is underpriced, and the unwind will be faster than people are positioned for. Carry trades don't end when everyone is scared. They end when everyone feels safe. And right now, the market is acting safe. That's the warning. This is Macro Pulse, Global Notes by JP. If you found this helpful, comment, like, share, and hit the bell.